Laurie, a little bit of a trim to your price target. Let's call it a trim. 4,700 from 4,860. Just walk me through your thinking over the weekend into this week.
Sure. John, I think we've all had the question on our minds, are we headed into a recession or not? And I will tell you that we have 11 different models that we look at, but a fundamental assumption behind all of our modeling is the idea that we're going to see a material slowdown in economic growth that skirt the recession. And so when we do that, we've basically updated our GDP models. We've added in a new valuation test, which was really responsible for a lot of the downgrade to the forecast. But in general, we think that the economic data we're taking the optimistic case here that the Fed will be able to pull this off. But we do think that bond yields essentially have taken a bite out of some of the forward return to the market. We talked about that actually in April. That continues to be the case today. And, Lisa mentioned peak bearishness coming on. That's something else we're modeling in. So we basically look at the recovery off of the low that we had on May 19th and factor in the typical recovery that we see in growth scares. And it's about a 25% type return. AAII, that net bearishness that we've seen there, also tends to give you a bit of a springboard. So while we are factoring in this economic ratcheting down, we do want to take account of the fact that sentiment probably has hit peak bearishness as well.
Laurie, I want to take an individual sell-side report. I know you don't want to talk about individual stocks, and I'm not going to ask you about Amazon, but Ron Josie over at Citigroup publishes on Amazon with a stunning view out 1, 2, 3, 4 years. The EBITDA growth from pre-pandemic is $43 billion out to a present $71 billion, out to a window in 24 months of $104 billion. I believe that's growth. You are pounding the table that growth does better as value fades. Discuss that.
So look, I think we also need to just take that economic environment we think we're in and apply it to sector and style positioning. And typically we see that when you exit a hot economy to a cool economy, one that's above growth to below growth or above average to below average in terms of the trend itself, you typically see value cede leadership. Value does well in a hot economy, and you tend to see growth outperform in that cooler economy. Now, defensives would do well in the recession, but we think that's, a risk, but not our base case. And when we look at growth as well versus value, we find that basically the relative valuation multiples are all starting to look reasonable or slightly attractive again. And if you look at the long-term growth expectation between value and growth, it had been sliding. So growth was really coming down relative to value. That tends to drive the relative PE multiple, but we have actually started to see some stability in that relative long-term growth expectation. In other words, investors have not given up on the idea that growth is better than value on the growth front, and that should give some support to the PE multiples here.
So, Laurie, what's going to drive the S&P? What's the leadership going to be to get it to 4,700, which is your new target?
So look, we like technology, and I want to stress that we are being very particular and very picky on that broader TIMT trade. So we don't like the communication services sector. We're neutral on consumer discretionary, but we like that classic tech sector where the valuations have gone from being ridiculously overvalued to slightly attractive to neutral, depending on what day we update the model. Earnings revision trends are actually starting to improve for the technology sector again, and it's one of the biggest sources of net income in the S&P as well as market cap. So we think that helps stabilize the market. And if we do have a peak in bond yields here, which is a call our rate strategy team is making, that should also help the tech sector stabilize in terms of performance. On the value side, Lisa, I would tell you look at financials. We've got a much better valuation case than what we've got in energy or materials right now. Earnings revisions are positive, but they're not peak-like, which I think they may be starting to look like they are in energy. And we really think that as the market sort of transitions away from the recession fear narrative and towards the slower growth narrative, that can breathe a little bit of life into this financials trade again in terms of a relief.